Chapter 12, Special Property Transactions. Learning Objective 1, Like-Kind Exchange Rules. So a like-kind exchange is a way to defer taxes on a gain for a property that is going to be transferred to someone else. And the property needs to be a productive use in a trade or business or for investment. So if we had vacation or rental property in Florida and we wanted to eliminate that from our portfolio of assets, and we could identify someone that wanted that to become part of their portfolio of assets. Well, ordinarily, we would sell it to them, and then the proceeds, if higher than the basis, that difference would be a gain that we'd realize and recognize, and then pay taxes on that gain. What the like-kind exchange rules are going to do is allow us, if we can identify another property, for example, a vacation property in North Carolina, to swap out of the Florida vacation rental for the North Carolina vacation rental, and then not recognize that the gain that would have been on the Florida rental property. Now, in order to do this, we've got three criteria here that we need to fit under. One is there has to be an exchange. So we can't actually sell to the Florida property to the future investor in that property and then turn around and purchase the North Carolina property. So we need to do something along the lines of setting up an escrow account that will hold the money, or to physically exchange property with that individual. But it's not a sell and then purchase later. This has to be one unified exchange. We can use an escrow account for that purposes, to where if we sell the Florida property ahead of time, then the Florida proceeds would go into escrow and be used to purchase the North Carolina property in the future. Again, these properties must be for productive use in trade, business, or investment, and they must be like kind. So if we're swapping out of our real property in Florida, we have to stay with real property for what we're purchasing. We can't purchase equipment or something along those lines. Now, the exchange rules are not elective, so if we do it correctly, then we're going to defer that gain, and if we don't do it correctly, we're going to recognize that gain. And then after 2017, those like-kind exchanges are only going to apply to real estate. So before that, if we had, we could do the same thing with a piece of equipment. For example, if we were a coffee shop and purchasing a piece of equipment to grind the beans, then we could possibly do a like-kind exchange using that equipment. After 2017, it's only going to be real estate that we're looking at for those kind of tax provisions. Now, a dealer is also not going to qualify. So if you're in the business of buying and selling real estate, you can't call all of your transactions like-kind exchanges, even if you do set that up in an escrow. And only real property, again, is going to be involved here, and if it's used in business and held for an investment, that only that property is going to be able to receive the like-kind of treatment. So here what we're talking about is we're not talking about personal residences. We're talking about the rental property or an investment property that we've purchased with a land and building. Now, for the like-kind assets, it has to be the same nature and character. So we're talking about exchanging real property for real property, but grade or quality does not matter. So if we have a $200,000 piece of property in Florida and $200,000 piece of real property in North Carolina, and the Florida property is in a desirable neighborhood, but it's kind of run down and a little bit seedy in terms of the neighborhood around it, and the quality of the house is deteriorating. However, the North Carolina property is off the beaten track, but is in pristine condition. That's not going to matter. We're trading real property for real property in this exchange, and we're looking at the valuations. Now, if the valuations match, then we're going to be able to complete that like-kind exchange. But however, if they do not, then we're going to have a concept that gets introduced here called boot or boot property. Typically what that's going to be is cash, and then we'll see later that it can also include assumption of some liability. So if there's debt on the property and we assume that also can be considered boot. But if we had a $200,000 piece of property in Florida and that we were going to sell that, $200,000 went in escrow, the property in North Carolina is only $180,000, then we're going to have $20,000 of what's going to be considered boot. So we're going to get receive a receipt of cash of $20,000 and then a like-kind exchange for the North Carolina property. Now we're going to recognize gain is going to be the fair market value of the boot received or the realized gain on the exchange. So here we could, assuming that there was a larger gain on the Florida property, let's say we had a $100,000 basis in it, and then $200,000 was what the proceeds that went in escrow. So we'd have $100,000 of realized gain. We're going through this process to try not to recognize, to try to defer that. So we'd have $100,000 for the realized gain of the exchange, and then the fair market value of the boot. Cash is going to have cash basis, so the $20,000 received, fair market value is going to have $20,000 valuation for it. So we recognize $20,000 of gain on that exchange. Receipt of the boot itself is going to cause the recognition of gain for us. Giving the boot, so the purchaser of the Florida property that went into escrow, giving the boot is not going to cause the gain recognition there. Now the actual calculation we're going to use for the receipt of property, we're going to take the basis of the property given, so in this case it would be $100,000, and then the boot given here, no boot was given in the Florida exchange on our behalf. We're going to have gain recognized, so we would have $20,000 in gain recognized, and then less boot received. So here we'd have $100,000 plus 0, plus 20,000 minus 20,000. So we would have 100,000 basis still in the property, but with 180,000 for the fair market value. So we have 80,000 of gain realized, not recognized. 20,000 of the realized gain would have been recognized. And then fair market value of property received less deferred gain. So what's the time period for identifying this? If we are doing it contemporaneously, then it's not going to be that problematic. However, if we don't know what North Carolina property, or even if we want it in North Carolina at the time we've identified the purchaser for our Florida property, we're going to have limits placed in terms of our searching for that the additional party for this like-kind exchange. We're going to have to identify the property, where it is, and which property it is in 45 days. And then we're going to have 180 days to actually receive that replacement property. So we're going to have to close on the North Carolina property in this example within 180 days. Now, the liability is assumed. If there's a release of liability, as mentioned earlier, that's going to be considered boot as well. So if we had $20,000 loan if there's either a $20,000 loan on the North Carolina property or the Florida property, and we are transferring that over and relieving ourselves in the Florida exchange of the debt we have on that property, or we're taking over liability or debt on the North Carolina property, it's the same as receiving cash to pay off that debt. So the release of liability is going to be considered boot the same as the way that cash is. And the presence of that liability can trigger gain in the same way. So let's take a look at our concept check here. With a correctly executed like-kind exchange, gain is never recognized unless the taxpayer receives boot. That is true, so we're going to defer that gain. 2, for a transaction to qualify for a like-kind exchange, an exchange of assets must occur, and the assets must be held for trade or business use or investment and be like-kind assets. That is also true. 3, a taxpayer has 180 days after relinquishing his or her property to identify a replacement property. That is false. We have 45 days to identify the replacement property, 180 days to close on the property. And then 4, the basis in the replacement property is typically the fair market value of the property received, less the gain postponed, and that is true. Learning objective 2, involuntary conversions. So in the like-kind exchange, we're intentionally going out and selling the property we have and replacing it with a similar type of property. Here, instead of selling our property, we may have something, a natural event occur that destroys the property. It may get condemned by the government. It may get stolen by someone. And then what we want to do is not recognize a gain based on the insurance proceeds that we have, or based on replacement property that we're going to receive for that. So we want to defer the entire gain. In order to do that, the replacement property that we purchase with the insurance proceeds must be for an equal or greater amount than the proceeds. So if we had our $200,000 Florida vacation home, and then it was destroyed by a hurricane, we had insurance on it, we need to replace that home with a $200,000 or greater home. If we only replace it with a $100,000 home and then pocket the difference of the insurance proceeds, then that's not going to defer that entire gain. So the replacement property also needs to be similar or related in service or use. So this is more restrictive than the like-kind exchange. So in the like-kind exchange that we looked at, we just had real property that we were looking at. So we had a real property in Florida, and we replaced it with real property in North Carolina. Similar related service, we're going to go one step further and say, well, was that vacation home or was that a commercial property for like an office space or something like that? To where if it's vacation rental property that we've got set up there, we can't replace it with an unrelated service, even if it is still real property. That we'd have to replace it with similar related in service. So if we'd be replacing it with another vacation rental property in its place. So the replacement period is going to be 2 years after the close of the tax year, 3 years for real business property. And then the basis of the replacement property, how we calculate that, we're going to have the basis of the converted property, so going to be our starting point. Less money not used to replace it. So if we received $200,000 and we did not use $100,000, we're going to subtract that from the basis initially. And then if it exceeds it, then that's going to go into the amount of gain. And then we're going to add money reinvested in excess of the proceeds. So if we have $200,000 received, we do purchase a $200,000 home. So, and then in addition to that, let's say it's a $220,000 home where we put an additional $20,000 in terms of improvements to the land around it, and that's going to increase the basis that we previously had. So in that case, we'd have $120,000, the $100,000 of the converted property plus $20,000 of additional money reinvested, and then we would not be subtracting out money for the replacement. So we'd have $120,000 basis and $220,000, and still have that difference of potential recognized gain in the future of $100,000. We're going to add any gain recognized to the basis, and then we're going to subtract the loss received. So we're also going to have a holding period. Holding period is going to be, the replacement property is going to include the converted property's holding period. So we're not going to, it's not going to be like a new construction. We're going to keep the holding period of the prior property that was involuntarily converted. So let's take a look at a concept check here. Assume the following facts to answer the questions. Fire destroys Andrew's building used in his woolworking business. He had purchased the building several years ago for $75,000, and it now has a $50,000 adjusted basis on it. Andrew receives $105,000 in insurance proceeds for the replacement cost. If Andrew does not replace the building, what is his taxable gain? So here we're going to have the $50,000 adjusted basis. $105,000 is going to be the proceeds. If we don't replace it with anything, then we're going to have it as the same as if we had sold it. So we'd have $105,000 in proceeds, $50,000 in basis. The difference being $55,000 is what we'd have to recognize as gain on that property. 2, how many years does Andrew have to replace the building in order to defer any recognized gain? So we've got 3 years, and that is because this is business real property. 3, assuming those same facts, how much gain would Andrew be required to recognize if he replaced the building with another building costing $95,000? So here we receive $105,000 in proceeds, and we've got the $50,000 basis. If we replace it with a $95,000 building, then we're going to have to recognize the difference of what we kept. So that $10,000 of proceeds from the insurance money is going to be recognized as gain. So how concept check question 4 here. How much gain would Andrew be required to recognize if he replaced the building with another building costing $115,000? So here we're actually putting more money in than the proceeds we received, so we're going to have no recognized gain. And then our 5th question says, how much would the basis be? Well, here we're putting an additional $10,000 above the proceeds. We had previously a $50,000 adjusted basis. We're going to add that amount that we put in for perhaps an improvement to the land or maybe a new deck on the building. So we're going to include that with our basis. So we'd have $50,000 plus the $10,000 to get $60,000 for the new adjusted basis. Learning objective 3, installment sales. So here, if we're purchasing a property and we're not going to include all of the purchase price in the same year in which we purchase it, or if we're selling a property and we're not going to receive all the money that we're selling it for in that same year, we're going to be under this installment sale situation. So it's going to be a disposition of property where at least one of those payments is received after the year of sale. And the payments are going to consist of 3 components. Typically, we'd ask for interest income, so it's similar to a loan that one would receive by going to the bank and getting a mortgage. We're going to have a return of basis, and then we're going to have a gain on the sale itself. So for the gross profit percentage, we're going to use, because we're going to want to know what portion of each of these payments that we receive is going to be a return of basis, and then what portion is going to be gain on the sale. We're going to take the gross profit that we have divided by the contract price. So similar to where dealers cannot use the like-kind exchange rules, dealers also cannot use the installment method, and it cannot be used for the sale of publicly traded stock. And then if you remember back to our depreciation rules, any depreciation recapture is going to be recognized in the year the asset is disposed of. So we're going to recapture that in that same year immediately. So let's take a look at a concept check here to get a better sense of how that gross profit percentage is calculated. For this concept check, it says we sold a tract of land for $30,000. The land had a basis of $18,000, and we incurred $2,000 in selling expenses. And we received $5,000 down, and then 5 additional annual payments of $5,000 each. So we've got a total of 6 payments of $5,000 to get to our $30,000 for proceeds. And what is the percentage of each of these payments that we're receiving that's going to be considered gain? So we need to calculate the gross profit percentage on the sale. So here what we're going to do is take our 18,000 basis plus 2,000 incurred as selling expenses. So we're going to have 20,000 associated with our costs, and then 10,000 is going to be gain. So we take 10,000 divided by 30,000 to get 1/3 or 33.3%. So 1/3 of those annual payments is what we could consider the percentage of those payments being gain. So how much of income will Tamara recognize in year 2 when she receives the first additional payment of $5,000? So if 1/3 of each payment is gain, we would take 5,000 divided by 3, and then get our $1,667, and that's how much we would recognize as gain in year 2. And then the difference, that 3,333, would be the amount that we'd consider a return of those costs. Learning objective 4, sale of residence. So if we sell a residence that we've had, and then we typically might sell it for above what we paid, without any exclusions, we're going to have to pay gain on that. Thankfully, the Internal Revenue Code gives us shielding up to $500,000 for married filing taxpayers, $250,000 for a single, of the gain on your personal residence. So if you have a personal residence that you purchase for say $200,000 and sold for $700,000 and you're married, or for $200,000 and sold for $450,000 if you're single, that additional gain can be excluded from gain recognition. So you're not going to have to pay taxes on that. And this is an exclusion, not a deferral. So it's not something that's going to go transfer the basis into the next property that's purchased or anything like that. It's just that amount of gain is not going to be recognized where you're paying taxes on it. Now, in order to qualify for this exclusion, you have to meet and satisfy a test here. So what we're going to do is look back 5 years prior to the sale, and there has to be an ownership test that's satisfied. So you have to have owned the home for at least 2 of those 5 years. And then there's a use test as well. So you have to have lived in the home as your main home, as your principal residence, for at least 2 of those years as well. Now, the tests do not have to be continuous. So in that prior 5-year span, maybe you lived in the home for a year and then traveled abroad for 3 years and came back and then had lived in it for the year leading up to the sale. So you owned the home for 5 of those 5 years and then lived in the home as your main principal residence for 2 years, the first of the 5 years and then the 5th of the 5 years. So that would meet and satisfy that test. Now, once you sell this home, purchase a new home as your principal residence, you can't immediately turn around and then sell that one for a gain. You're going to have a wait here to where you can only use this exclusion once every 2 years. Now, you could still sell the other home, but you're not going to qualify for the exclusion. And then, additionally, if for health or employment reasons, you have a reduced exclusion that's going to be available for that second sale based on the ratio of days owned divided by 730. 730 being 365 times 2. So if you may not want to sell the second home, but health conditions have deteriorated and force you to do so, or your job transfers you and forces you to do so, then you can still qualify for a portion of that exclusion. And it's going to be the portion of what percentage of the 2 years that you had been in that home. So let's take a look at our first concept check here. If a married taxpayer lived in their personal residence for more than 2 years, the couple can exclude the gain on the sale of the residence up to $500,000. That's going to be true, with single taxpayers being $250,000. Concept check 2, a taxpayer cannot exclude any gain on the sale of a residence if he or she has lived there less than 2 years. That's going to be false if health conditions have forced you to sell the home, or if your job has transferred you away and employment conditions are forcing you to do so. Then you can get a percentage of the 2 years that you've lived there, again, a percentage of that exclusion. Concept check 3, Sharon and Johnny were recently married, and Sharon moved into Johnny's house. Sharon then sold her home and took the exclusion. Since Sharon took the exclusion, Johnny must forfeit his exclusion if he were to sell his home within the next 2 years. So that is false. He can still have his exclusion up to the $250,000, but would need to wait for the full $500,000. Learning objective 5, related party losses and wash sales. So losses on sales between related parties are going to be disallowed. So what this is going to be for a related party is if you're selling to a family member, or if you own businesses and one of the businesses that you own is selling to another business that you own. And we're going to have constructive ownership rules are going to apply here as well. So the loss disallowance does not affect the basis of the property to the buyer. So this is going to be to where if you have a $5,000 basis in one piece of property and you sell it to a family member for $3,000, you can't use that $2,000 as a loss. You can't recognize that loss. So wash sale rules are going to disallow tax loss where the ownership of a company is not reduced. And a wash sale occurs if essentially the same stock is purchased 30 days before or 30 days after the sale. So if you had purchased a stock for $10 and went down to $8 and you sold, ordinarily you would have that $2 difference per share, so depending on how many shares that you had sold, that you could use as a loss to offset other capital gains, or up to, say, $3,000 if you were using it to offset ordinary losses, similar to what we had talked about in previous chapters. But the wash sale is going to be considered to have occurred if the stock went down to, say, from $10 to $8 and then went up again to $9, and then you immediately just purchase that stock within that 30-day window again. And these wash sale rules are going to disallow the tax loss where, again, where that ownership of a company is not going to be reduced. So let's take a look at some examples to maybe flesh this out a little bit better. The first is going to be that Leslie sold 500 shares of Bluff company stock to her brother for $5,000, and then she had purchased the stock 3 years ago for $7,000. How much loss can Leslie deduct on her tax return in the current year? So that's going to be none. So this is going to be considered a related individual that is selling it to her brother, so that $7,000 for the amount she purchased it for, $5,000 for loss. So you'd have $2,000 that would be potentially realized as a loss, but none of it's going to be able to be kept. So learning objective 2, would the answer to question 1 change if Leslie sold stock to Leslie Company instead of her brother? Explaining, given the following facts here, assume Leslie owns 25% of the shares, and then assume she owns 75% of the shares. 1A, Leslie can deduct the entire $2,000 in terms of a capital loss, and that's because she doesn't have a controlling interest in that company. So it's not going to be a related recipient. And then for B, she owns a majority of those shares, so she's selling essentially to herself constructively, so the entire loss is going to be disallowed, the same as it was when she had sold to her brother. Concept check 3, what is the purpose of the wash sale rules? And that's going to be to disallow tax loss where ownership of a company is not reduced. So if you buy similar stock within 30 days, either before or after the stock sale, the loss on that sale is going to be disallowed, so you're not going to be allowed to use it.